Hey everybody, Brian Bogner, Greg Towner here. It is March and it's time for our monthly market and economic update. So let's go ahead and get started. Greg, we always start with the U.S. Talk to us about U.S. stock price trends right now.
Yeah, absolutely. It's a three-year look at the S&P 500, and we can see that here in recent weeks since we last spoke, the market has continued to chug along higher. Got stalled very briefly at kind of a 2,800 resistance area, but it's kind of punched through there as we speak, really. And everybody keeps waiting for that pullback, that retest, and maybe it eventually happened, but it hasn't happened right now. And sometimes that's a sign of strength.
Good deal. Now, I know U.S. has been a very good place to be compared to the rest of the world, but are U.S. stocks too extended right now when you compare them to international?
Well, this chart here is going to look back all the way to the 1950s, and you asked too extended. Well, it's definitely extended. Who will know when or if it is too extended? But we can see going back to the 1960s, it was really stretched, the so-called Nifty 50 stocks that were so popular. And then back in the 90s, of course, the internet bubble, it got extended there, about one standard deviation move. But now with the so-called FANG stocks, the big technology stocks, U.S. stocks compared to international are as extended as they've essentially ever been. Now, that doesn't mean it has to move the other direction right away or frankly, even forever. No one knows for sure. It's definitely something to open our eyes and say, hey, U.S. stocks are extremely popular. At some point, there could be a shift, and it could be a long-term shift. Yeah, this is a chart just strictly of developed international stocks over the last few years. And last year was not a pretty picture. There's a clear downtrend there. But like U.S. stocks, it's now popped up above its major moving averages. Still has some work to do, but showing some good signs of life. So perhaps we are in the early innings of starting to see some international movement. I know you wanted to take a look at this list, Brian. What do you see here?
What I see here is that the U.S. is not always the best house in the neighborhood. I think a lot of times, I get asked a lot, like, why do we own international? Why do we have international exposure? And while it was frustrating this past year, as you can see here, I mean, this is just year to date. So after the past few months, we've got, good handful of countries that have either done just as well or not better. U.S. is still in the top third, but, there's still a lot not too far behind. So, even though, like you said earlier, we're very, very extended right now, we could potentially see some reversion to the mean here and start to see some of these other areas. I know we don't have a slide on it, but I know from a valuation standpoint, a lot of these other countries are trading at much better valuations than the U.S. All right, let's go ahead and transition over to the economy.
Yeah, we're getting a fair amount of economic data coming in that shows some slowing here in the first quarter. We found this chart interesting that shows over the last almost 10 years now the seasonality of GDP. We're getting close here to getting the first quarter GDP. I see a lot of estimates under 2%. I've even seen some under 1%. And if that happens, don't be too alarmed, too shocked. And we had the government shutdown. We did have some severe weather in parts of the country. Would not be surprising to have a low GDP again this first quarter. And hopefully we get the trade wars figured out and all of that, and things kind of pick back up going forward throughout the year.
And I think the other side of that coin here, Greg, is if you look at this chart, this is the difference between a 10-year treasury and a 2-year treasury. And it essentially gives us an idea of what the yield curve is. And this line going right across the middle here, okay, is 0. So basically, when it reaches this right here, the 10-year yield and a 2-year yield are exactly the same. But going back to the 80s, as you can see, any time that this line is at, we say the yield curve goes negative or gets inverted, there has been a recession. That's what these gray bars are afterwards. Now, we are very close. Does that mean we're going to get a recession? Absolutely not. But it's something that we are monitoring very closely right now. like you said earlier, we're believing that this first quarter will be more seasonal. But if we see this here get negative, it's certainly going to adjust some things that we're looking at and doing there as well. So in review, U.S. stocks continue to recover from the lows back in fourth quarter of 2018. They're still showing strength, and you've got to participate in that strength. International stocks are finally improving. Relative underperformance is at record levels. Typically, you begin to start to see a little bit of inflection there and potential change. And the economy slowing could be seasonal. At this point, that is our thesis. If that changes, we will certainly let you know. So any questions, thoughts, or comments, you know how to reach us. You know where to reach us. Thank you so much for listening today, and have a great day.